The average CFO accumulates 2.8 million in net worth by age 55. The average American accumulates 192,000. The difference isn't intelligence. It's not luck. It's a single operating system they use to deploy every dollar they earn. And the shocking part, you don't need a six-figure salary to run it. Here's what most people get wrong about wealth. They think it's about income. So they chase the promotion, the job title, the corner office. But a CFO making $180,000 a year will outpace an entrepreneur making $500,000. Not because they're smarter, because they have a framework. They know exactly where every dollar goes before they earn it. They understand leverage. They automate their savings. They separate their identity from their spending. Most people do the opposite. They earn, they spend, they wonder where it all went. According to a 2023 Federal Reserve survey, 46% of Americans couldn't cover a $400 emergency without borrowing money. Meanwhile, a mid-level CFO has that in liquid reserves before breakfast. The gap isn't salary. The gap is systematic. In the next 8 minutes, we're going to walk through the exact three-part operating system CFOs use to build wealth on any income. This isn't theory. This is how Janet Yellen's team taught Treasury analysts to manage personal capital. This is how Goldman Sachs' financial planning department trains new employees. This is the same framework that turns $60,000 a year into real generational wealth. By the end of this video, you'll understand the principle that separates accumulators from spenders. You'll know how to architect your cash flow so that wealth builds on autopilot. And you'll have a specific 30-day implementation plan that works whether you make $50,000 or $500,000. Let's go. Point 1. The CFO income statement. Your personal P&L. CFOs don't look at gross salary. They look at what McKinsey calls net deployable income. That's take-home pay minus committed expenses. The number that's actually available to work for you. Most people never calculate this. So they think they're broke when they're actually not. Here's the evidence. Research from the Center for Retirement Research at Boston College found that high net worth individuals track their cash flow to the dollar. While the median American can't account for 40% of their monthly spending. One uses data. One uses hope. A real example. Sarah, 42, made $95,000 a year. She felt strapped. She ran the numbers with a CFO mindset. Gross, $95,000. After federal, state, and FICA taxes, $67,000. After housing, insurance, and food, $42,000 left. She'd been looking at the 95 and feeling poor. The actual number she could deploy was 42. That's her real salary. Once she knew it, everything changed. Here's how you apply this. This week, pull last year's tax return. Find your net income after taxes. Then list every committed monthly expense. Housing, insurance, subscriptions, debt payments. Subtract that from your net. The number you get is your personal net deployable income. That's not a sad number. That's your real financial engine. Write it down. You're going to use it in point 2. Point 2. The velocity rule. How fast money moves out of your control. A CFO thinks about money differently than most professionals. They think about how quickly capital leaves their sphere of influence. In corporate finance, it's called cash velocity. In personal finance, it's the fastest route to poverty or wealth. The evidence is stark. A 2024 Vanguard study showed that investors who automate savings accumulate 3.7 times more wealth over 20 years than those who manually transfer money. Automation removes the decision. And decisions are expensive. Consider Michael, a senior analyst at a fintech firm earning $110,000. He made good money. But he'd look at his account every month and find it empty. His problem wasn't income. His was that money sat in his checking account waiting to be deployed. Waiting meant temptation. Temptation meant lifestyle creep. By day 15 of the month, most of it was gone. He restructured his paycheck. 40% went straight to a high-yield savings account he never looked at. 30% went to a separate brokerage set to automatically buy index funds. 20% went to a checking account for living expenses. 10% to fund money he could spend guilt-free. He didn't earn more. But in 18 months, his net worth moved from $60,000 to $142,000. The only change was velocity. He shortened the time money could leak out. Here's your application. Go to your employer's payroll system. Split your direct deposit into 3 accounts. A savings account you don't touch. An investment account on autopilot. A checking account for living expenses. If you're self-employed, set this up with your bank today. The money you never see is the money you keep. That's the CFO move. Point 3. The debt to leverage ratio. How to use borrowed money like a CFO. This is where most people fail. They think debt is bad. CFOs think debt is a tool. Bad tools wielded wrong cause damage. Good tools wielded right build empires. According to the Federal Reserve's 2023 Distributional Financial Accounts Report, the wealthiest 10% use leverage strategically while the bottom 50% avoid debt entirely but also build almost no wealth. That's not coincidence. That's causation. Here's a real scenario. 2 people, both making $85,000. Person A paid cash for a used car. Person B got a 0.9% auto loan and invested the difference in a diversified portfolio. Over 7 years. Person A had a paid-off car worth maybe $12,000. Person B had that same car and $67,000 in investments. Even accounting for the loan payments. Same salary, different math. The difference is understanding leverage. The CFO framework is simple. You use debt when the asset you're buying will generate returns higher than the interest rate. You avoid debt when you're borrowing to consume. A mortgage at 6.5% makes sense if your property appreciates at 3 to 5% annually and provides you housing. That's leverage. A credit card at 22% for clothes is wealth destruction. That's recklessness. Here's how you apply this. Audit every debt you carry. List the interest rate and what the asset will produce. Mortgage at 6% on a home generating equity and housing value. Keep it. Student loan at 4.5% from education that raised your earning power. Optimize it. Credit card debt at 18% for past consumption. Eliminate it in the next 90 days. This isn't about being debt-free. It's about borrowing like a CFO. Strategically. Picture yourself 24 months from now. You've run your income statement. You know exactly what you can deploy. You've set up automation so that money moves before you see it. You've stopped the leaks. You've structured your debt strategically. Your net worth has grown 40, 50, sometimes 60%. Not because you got a raise. Because you redirected the money you already had. You have 6 months of living expenses in liquid reserves. That's not a number you check anxiously. That's a number that lets you sleep. You have positions in index funds compounding tax deferred. You have no credit card debt. Your financial life is running on a system, not on willpower. And here's the thing. Nobody around you sees it yet, but you feel it. The stress is gone. The financial arguments with your partner are gone. Your path to real independence is visible now. Not in 40 years. In the next decade. Because you started thinking like a CFO on a regular salary. And that changes everything. If you've been playing money by ear, this framework will reshape your next 24 months. Subscribe to Apex Minds. Hit the notification bell. Every week we publish finance and leadership frameworks that most people discover too late. Here's what's coming next. We're breaking down the single question every high earner should ask their accountant before January. The difference between the answer most people get and the answer CFOs get costs the average professional $18,000 a year. You're not going to be most people. You. Thanks for listening. If you found this valuable, please subscribe to Apex Minds D4J for more powerful insights. See you in the next one.